So welcome. How do you tailor institutional investment strategies for the families and the entrepreneurs that you work with?
So we take the endowment model, which is kind of popularized by David Swenson at Yale, and we've adapted that over the years specifically for families. So the original model was high systemic risk level, long-term investment horizon, a bias to alternative managers. On top of that, for families and entrepreneurs, we're layering on governance considerations, concentrated stock positions, liquidity needs. And then over the last few years, we've further adapted the investment model. So a focus on risk management, being nimble into and out of asset classes, and then finally kind of moving beyond the sort of 2 in 20 traditional allocation to asset managers, partnering with asset managers, whether it's co-investments, feeder accounts, or separately managed accounts. So there's a few ways, both in terms of the investment model, but overall, the overall approach that we've kind of adapted for families over the last few years.
Why is a multi-asset strategy so critical in today's environment?
It's unbelievably important in this environment because today we're in a different regime than maybe we were over the last kind of 10, 20 years or so. What do I mean by that? The last 20 years or so, we had low inflation, low interest rates, low geopolitical uncertainty. Today, we've got all three of those are the opposite. We've got high inflation, high interest rates, and high political uncertainty. So what that means is that the kind of 60-40, maybe traditional equity bond, simple portfolio doesn't just look outdated, it's fragile. And so a multi-asset class model is really about creating resilience in a portfolio. It's not just about diversifying for the sake of diversifying. It's not just having or, spreading your eggs in different baskets. It's having specific allocations that have a role in the portfolio. So hedge funds to protect you against equity market drawdowns, or real estate or infrastructure to give you inflation protection. Private credit, for example, to give you income that's kind of less correlated to equity markets. So really it's about trying to help our endowment foundation family clients to compound capital over multiple years, which is really what they're solving for.
So your strategies are growing as sort of, I suppose, the macroeconomic conditions and political conditions change. It is such an uncertain time. It's a lot of volatility. How do you make sure that you are resilient and that you build resilience in for your clients?
A part of it is kind of our history. 20 years of doing this, we've learned from lots of different periods of history, whether that is dot-com bubble, 0809, Greek financial crisis in 2011, COVID, the last few weeks even. And one of the biggest things is really going back to basics and keeping things simple. So managing your risk level, being unemotional about it. So rebalancing when markets fall, so buying back equities or selling equities when markets rise. Number two, it's really around maintaining liquidity. So having enough liquidity such that if there are opportunities or you do need to rebalance, you've got enough liquidity to do that. And number three, it's being tactical. So in various different market regimes, there will be different supply and demand imbalances of capital, and you need to be in a position to take advantage of that. So it's really taking all the learning for the last 20 years or so and then implementing it in today's portfolios.
Can I ask you, you work closely with tech entrepreneurs and founders here in the West Coast.
Yeah.
Do they have a different mindset, a different way of approaching wealth and legacy and philanthropy?
These are people that have been very successful in the world through kind of big, bold bets. Typically, they've been contrarian. They've had to be contrarian to be successful. They embrace complexity. They want to learn, but they do things their own way, which is why they've been successful. So when it comes to their investment portfolios, they have great networks when it comes to investing in tech businesses, venture investments. And so you look at their investment portfolios, they've got really super high quality co-investments, direct investments, venture investments. Where they kind of want to work with a firm like us is the other bits in the portfolio. So the areas that require resilience. So I talked about hedge funds, I talked about private credit, other asset classes. Secondly, kind of putting it all together. So often they'll find that they've got this kind of highly concentrated tech exposure, but they need to think about, all the other assets in their portfolio, whether it's a personal property or these other asset classes I talked about, how do they all fit together and how do they manage the risk at the overall level? And then lastly, it's about, we're helping them figure out how do they install their values in their investment program? How do they think about generational transition? So the big piece of all of that is, given that they're so contrarian, they've done things their own way. They want a fully customized approach, whether that's the portfolio, the governance, the way in which we're managing it. And that's kind of where we come in to help them.
Fantastic. So thank you so much for your time.
Thank you.